Hey guys, it's been a while since I made a video, and the reason why is because I've been extremely busy, and I apologize. I'm not a financial advisor. None of what I'm going to say or have ever said has been financial advice. This is just my humble opinion and a joke at best. Please do your own research. So, the reason why I'm making this video is because I had read a few economic articles, and I've been wanting to make a video for a while to give my views and share my thoughts on things. And while my views and thoughts are ever changing as the economic conditions are constantly changing, there's a few things I want to go over, specifically with the macroeconomic events that we're seeing currently going on and how it could affect the stocks I invest in personally. And again, none of this is financial advice. Please do your own research. This is just my humble opinion, and it should be taken as a joke at best. I'm someone who invests in Chinese companies, so what happens in geopolitics and economics, these things really do matter to me, and I do follow them because I would like to know how to position myself best. And so I took some notes here, and I incorporated some of the material from these three articles that I had read from economists. I believe they're economists. And I'll be going over today the impact of the renminbi appreciation on Chinese stocks and companies. And I'm going to take it step by step because I'm sharing my own views, because this is actually a summary of things. And this is very specific, so I will be leaving a lot of things out. Like, there's a few things I want to talk about, like how the United States, why I believe China is much stronger in terms of economy versus the United States, and why I think the United States is in such a vulnerable position. Like, I probably won't be going in that too much in this video, because maybe that's for another video. Maybe I won't go into how, like, I believe the United States is a Ponzi scheme based on their demographics being substantially reliant on appreciating asset bubbles in a debt-driven economy, and how how a large portion of our retirement age in America is dependent on asset and stock appreciations, and if they don't, there could be a collapse in our economy. I'm not going to be talking about that too much either, but I will be taking my time in this video because, well, it's a Friday. Like, you're not going to be trading and investing anyway, so if you have some time, you're out walking or fishing or something, maybe you can play this and find a little bit of value within this. So again, none of this is financial advice. Please do your own research. I'll be going over these notes I've taken, and I will just share some of my point of views, and I will be going on tangents. So if long form videos aren't your thing, I'm not for you. There's a lot of great people making videos out there, so yeah. So again, yeah, I'm someone who invests in Chinese companies, so I do try to follow like the macroeconomics and the geopolitical news, and I try to make assumptions and my own frameworks of what could be happening in the future based on historic, using comparative economics, and then trying to understand like what's currently going on, what could happen, and place my bets in response to those things. So again, yeah, the main focus is the impact of the RMB appreciation on Chinese stocks and companies. And a few keywords is just RMB appreciation, Chinese stocks, exchange rate impacts, and corporate financial performance. So my hypothesis is that the appreciation of the renminbi is strongly correlated with the financial performance of the Chinese companies and their stock prices between 2005 and 2020, and 2020 and 2024. With 2020 and 2024, it's a little different because you have so many variables going on, so it was hard to really consider that, because when it comes to long-term predictions, I think it's a little bit, the accuracy of long-term predictions is probably has a higher rate than short-term, because short-term, it's really complex, and there's too many things that you would need to consider that you probably won't even think about when trying to predict accuracy or predict things. And so the formula is pretty much here: X, A, Y, B, T, and Z. Appreciation of the RMB in the country of China, the financial performance of these Chinese companies and their stock prices, the stock market's performance, Shanghai, Shenzhen, and Hong Kong, yeah, between these dates and the context of the global financial markets and economic policies from China. So, the appreciation of the RMB could significantly influence the financial performance of these Chinese companies and their stock prices. This is because the RMB appreciates. As the RMB appreciates, Chinese companies benefit from increased purchasing power, reduction costs for importing raw materials and investments. So this means like as the renminbi appreciates versus other currencies, then like a company like NIO, for example, and I'll probably use NIO as one example. They can buy their raw goods for their manufacturing at a much cheaper cost in a sense, because what they would initially be paying, like, I don't know, 20%, as an example, like 20% of their cash on hand. Like if they were to use 20% before, as their value of the RMB increases or their currency increases, then maybe those costs would make up 10%, and that could be reflected in their financial statements and things like that. So yeah, input costs could lead towards improved input costs could lead towards improved profit margins and stronger financial statements. This would be seen in like your quarterly earnings and things like that. But I think companies like NIO or companies in general try to time when they're going to buy a lot of their raw materials or their goods and services that they are eventually going to need for their company. A stronger RMB can make Chinese stocks more attractive to foreign investors by reducing perceived risk. This in turn could increase foreign investments and higher stock prices. So when your currency is stronger, then your economy is perceived as stronger. In order to have a stronger currency, you need to have a strong economy, and you need to have more credibility and reliability on your currency as well. There's a lot of assumed positives with having a higher currency, but this is all relative, right? So the Chinese economy they could maintain their currency relative to another currency, but they may want to keep it at a certain range so they can be competitive in exports while being beneficial for the domestic economy and for whatever purposes they have, right? So if you're like a economy like China, then you don't want to have your currency too strong, because you also want to develop other countries through too, and you don't want to exploit other countries financially like the United States does, especially if they're borrowing money from China. But then again, like, this is all very contingent. This all depends on like the structure of agreement between two countries and in international trade. So this is why like a lot of what I'm going to say is very contentious, because it's all about the context of the type of transaction and more. So this is why it's long-winded, because there's just so many things to go over. Chinese companies with foreign denominated debt could benefit from reduced costs. This is applicable for a multitude of Chinese companies listed on multiple exchanges and those seeking to diversify their currency holding for special purposes, looking to access larger liquidity and potentially borrow at lower cost. Foreign denominated debt and management of currency could also benefit from a stronger balance sheet, depending on how they're positioned in response to the appreciation of the RMB. So this could be like if you're trying to raise bond, like if you're Alibaba and you recently issue bonds in the United States, then depending if the value of the dollar is relatively high compared to the Chinese RMB, then you could have currency arbitrage in the long run if the RMB appreciates versus the dollar. Or you could benefit that it could help bolster your balance sheet as well, depending on the nature of the currency you're trying to raise. So I guess with the case of NIO, or Chinese companies in general, if they want to diversify their currency and purchase other raw goods or materials with that currency, it may be more favorable than using the RMB. But if the RMB becomes more powerful in a sense, then it'll be beneficial for Chinese companies. But this all depends on like how you diversify your currency as a company. So like another example is like Tesla and having US dollars while also holding Bitcoin, right? Two different types of currencies. I use this as an example because it's more apparent with the price fluctuations with Bitcoin and how Tesla can use Bitcoin as a means of transactions to buy things for the company, or as a means of exchange for goods and services that they sell, or they can sell it in exchange for other currencies like the US dollar. This part was mostly from the articles I was reading. I thought it was pretty interesting because they go over a few different types of mechanisms, which include international trade, hot money channels, and domestic credit supplies. But I probably won't be going over this too much. I will have this for you available in the description if you want to read over it. And then you can reference the PDF to get a different view on things, because I may not always be right. So some of the side notes I have here is that when considering the exchange rate between the RMB and USD between 2005 and 2020, the impressions I'm getting is that of the Shanghai Stock Exchange and the Shenzhen and Hong Kong Stock Exchange is that there seems to be some sort of correlation between these stock exchanges and the rate between the RMB and the USD. So what I noticed is that when the Chinese yuan rised in value compared to the US dollar, I saw that other exchanges, that Chinese exchanges in response rised as well. Now this could just be a result as like domestic economic growth and other companies growing within these exchanges, but there probably is like a positive correlation between the RMB appreciating in value, and it's because like input costs could be cheaper. The export costs could go down. Export competitiveness could go down depending on what industry you're in. But if you rely on domestic consumption, like a NIO, right, that doesn't export too much outside of China, but focuses on supply chains in China and manufacturing in China, then it could be beneficial to have higher appreciation RMB value versus the dollar versus not. But if you're exporting things like textiles, or you export low goods and you rely on the US market, then you may see some negative impacts on that on your revenues and your margins generated from that specific industry or whatever you're exporting. So like if you are Alibaba or a Temu, for example, or a Shein, then maybe some of your exports could go down in competitiveness because of the appreciating RMB versus the dollar, for example, because you're relying on like foreign revenues. But these companies don't necessarily rely on the United States too. They export globally, but they could see some lowering. They could see some of their margins and their revenues decline as a result. But this is all very. It's all about context too, and what you're exporting. So it could be beneficial for a company like NIO, but maybe not for others. But yeah, so when I was looking at these things, there is a correlation with the Hang Seng, the Shenzhen, and the Shanghai Stock Exchange with how the RMB has performed. So I personally think the RMB could appreciate in value, and this is because there's a mixture of a lot of things going on, but it's very apparent now. So why I think the RMB could appreciate in value versus the dollar is because I think China is in a position where they have so many economic advantages over the United States right now. And so I should have took notes when doing this, but I'm gonna just speak on the top of my head because I think it would have taken me too long. When you look at the United States economy, what you need to understand is that it's a very debt-driven economy where manufacturing has gone down. There's high numbers of poverty. There is an increasing wealth gap. And how most Americans and a lot of Americans rely on their retirement and their exorbitant cost of livings is through asset appreciation, like your stocks, your homes, your real estate, and your bonds, in order to supplement your retirement funds. And these retirement funds and pensions and your own personal portfolio, yeah, they make up your net worth. All these things are stocks, bonds, and real estate, right? So the United States needs to have these assets appreciate in nominal value, even if the real value of things are depreciating or maybe aren't really justified or substantially lower. But this is all very inflationary. So the United States may have to keep their the United States is in a position that they're going to have to keep increasing the value of their stock markets and assets and things like that. And it's all like a negative doom loop where it just keeps pumping up. And eventually it could crash, right? But if these things crash, right, which make up people's retirement and pensions, then eventually these people could die because they don't have a means to supplement their cost of living. Social Security is not enough either. In China, though, or in other Asian countries, or in less developed countries, or in countries that haven't benefited from colonialism, they have multi-generational households. So if the elderly or the demographic of older people who rely on pensions and 401ks cannot supplement their living standards that they used to have, well, they generally live with their family anyway. So they can offset the rising cost of living through generational households by having like their son or their daughter or their granddaughter and son offset some of their cost of living. So let's see, American. So I guess the best way to put it, and I'm using this as an example, is that you see here, 60, after the age of 60, that used to be like the idea of when Americans retire, right? So this large portion of America relies heavily on stocks appreciating, their home values, assets, pensions, 401ks, and retirements, right? So you can look at the S&P 500 as an example of this, right? So you can look at home values as well, home value, asset, bonds, things like that, the debt. All these things are increasing, and this is a good way to just look at it, just to visualize our national debt. You can just look at the S&P 500, and this is probably increasing correlation. So this economy, these people rely on this appreciation and these debt-driven bubbles, and if the bubble pops, then you're going to have a financial crisis, probably comparable to the Great Depression. So the United States isn't in a position to really bargain with China. China is in a substantially stronger position. Their real estate market has popped. Their equity markets has popped, yet China has remained resilient because of the way their economy is structured. Again, like the generational households, how they view savings, their more conservative financial cultures and values versus the United States. So the United States is in a position where they need to keep pumping up the markets. They need to keep creating more debt. And they don't have the means of production, and they don't have the manufacturing to compete with China. They are heavily dependent on colonialism, where they siphon out materials, financial goods, and resources from other countries, from developing to somewhat developed and developed countries, in order to sustain their debt-driven economy. So, but one of the main things that the United States benefits from is from the stock market. But if the Chinese stock market outperforms the United States, then Chinese companies in return will have more cash on hand. They'll be able to expand and outcompete United States companies even more, which means that, well, your stocks can't be valued even higher because your company's performance are declining. Just like if you look at Apple, for example, or if you look at American automobile companies, they're being outcompeted by Chinese companies and Chinese phone companies, for example. And they're taking away market share. So eventually these companies will have to go down in value. These stocks will have to go down in value in response. That's why you have the Mag 7 and a few other companies holding up the indices, because without that, you'd see a more realistic example where maybe around like the 2,900, 3,000 plus companies in the S&P 500, not S&P 500, but in the New York Stock Exchange, it would show a more realistic version of things, and it's just not doing that well. So if you have stocks that are doing not too well, I wouldn't feel too bad, because the S&P 500, like many of the United States indices, portfolios, retirement, and 401ks, are being held up by a small handful of companies that are tremendously overvalued. So yeah, so like this large demographic of people in the millions rely on, hundreds of millions rely on this debt-driven bubble. But with the rise of BRICS, with other countries wanting to de-dollarize, with other country stocks exchanges becoming more attractive, with how belligerent the United States has been handling foreign affairs, geopolitical tensions, and just other countries rising and competing with the United States exports in their financial markets and their low to high value goods, you're going to see that a lot of countries are deleveraging from the United States, and a lot of the means that the United States had to sustain its debt-driven economy are becoming less and less. And it's possible that the United States can offset these deleverages and these the increased competition through more immigrants or more inflation for like the poor and working class, more wealth gaps, and another form of poverty below the current poverty in the United States to sustain this debt-driven bubble. But I think that China is actually competing in a lot of the exports in both the high, low, and medium value exports. So this includes their financials, right? So maybe the United States used to dominate in the IMF and World Bank, which they can siphon out. They can have these really, they can have these very exploitative conditions for like other countries, so they can benefit from that. The issuing of debt, they can like issue terrible trades, but China has their own version of this through BRICS, right? Or through the Belt and Road Initiative. So China can compete for the business of developing countries, and they can undercut the United States by offering these other countries better terms of service, better agreements, and better contracts, which takes away money from the United States. So the United States hates China for numerous reasons, and it's mostly because China is succeeding in giving other developing countries an alternative to the United States. The United States is actually a colonial country. It's a country that relies on imperialism and colonialism, while in a sense China as a byproduct is just helping decolonize the other countries. So in a sense, China is kind of like a savior for these countries because it gives them more options. An example would be is that if you look at countries in Africa, maybe before the United States could lend every dollar the United States lends to Africa, Africa will eventually have to give $100 back. But now China is like, okay, if you give me, I'll give you $1 for every. Okay, here's an example. So like if the United States used to lend money to Africa, they used to be like, okay, here you go. You can have some things. You can have some food, some foreign aid, and we'll set you up with a little bit of things, so that way we can extract your raw goods and materials, but we'll keep you in perpetual poverty through our exploitative trade agreement that we have with you. And the Africans will be like, well, no one else is going to trade with me, and I want to develop my country, but I can't because the United States won't let me, and they interfere with our politics and governing, and they keep us in an extractive position where we are constantly vulnerable economically, and we can't develop to actually compete with the United States economically, so we have to give them $50 back in raw materials and goods for every $10 they give us. And without this, we're going to starve to death. And when China comes in, they can offer a better deal and say something like, well, the United States gave you $10 and they keep you in an extractive position. However, we'll give you, for every $50 we give you, or for every $50 worth of raw materials and goods you give us, we'll give you $45 or $50 or even $55 worth of the means of production, so you can boost your economy. We'll give you education, we'll give you skill, we'll give you health care, we'll give you investments, and we'll give you skilled labor, we'll give you these things in return. And the reason why China would do this is because it helps these countries decolonize from the United States, which benefits China, because it means that it means that the United States will come down, because the United States is in a position where they are just overly leveraged. They are just too powerful relative to other countries. So this is being done on a global level, and because the United States relies on Ponzi schemes, debt-driven economies, debt bubbles, and the siphoning of raw materials, goods, and resources and values from other parts of the world, then that means that these countries that were once forced to do business with the United States no longer have to. So I do actually have some more videos that go into that more, but yeah, those things need updates, as everything does, because things are constantly changing. But yeah, so this is just one example, right? So before, if the United States had full control over these countries, and even China, right, during the Opium War, and even before that, the century of humiliation, where the United States would exploit the South America, they would South America, they would exploit Asia, China. They forced the open borders in Japan. They annexed Hawaii. They took advantage of Southeast Asian countries. They took advantage of Africa. And it's not just the United States, right? It's a lot of the European countries as well, right? A lot of these, like the France, British, a lot of European countries were also, the Spaniards, they're all competing for global dominance through colonialism. And so you have like legacy colonialism where the United States benefits from, in a sense, an example, like, oh, I benefit from unfair trade. Like, I can make these people in China export me $2 for every $100 I invest. They give me $1,000 back of goods. You know, same thing with Africa. Oh, every $100 I invest in Africa, I'm going to get $1,000 back of goods and services in return. Same thing with South America and different parts of the globe. So these things are deleveraging, they're decolonizing, and in response, the United States is losing its power, its money, its economic advantage. And because they don't have their manufacturing they once did, because other countries like China are out competing the United States in low, medium, and high, and other developing countries are starting to compete for textiles that the United States used to have, you're in a position where the United States is heavily dependent on its financial system and its military. But it's kind of like at this point, it really is a Ponzi scheme. It's really a really fragile bubble. So like, if these two countries were to go into an economic war, The United States has to keep printing money. It has to keep increasing its national debt in order to sustain itself. And if I were the United States, personally for me, if I were the United States, I would try to make this Ponzi scheme, this debt-driven bubble, last as long as possible till this demographic dies off, because then you can alleviate some of the financial pressures and you can disperse the debt onto this demographic of people, and you can maybe try to compete in high and medium value exports and manufacturing in the long run, because you can't really benefit from the advantages and privileges you had before. So yeah, to me, the United States is in a very vulnerable position, and I will probably make a video that's more accurate on this, that was more planned out, because this is a very complex subject. But it's actually very unhealthy to have your company's your stock market be carried by by like Nvidia, for example, because that means your stock market is very volatile, and it's really scary, because if the Nvidia bubble pops, or you start realizing that 30 billion in revenue does not equal a $3 trillion market cap's company, then if you're at a retirement age, wouldn't you be really scared? You don't know if you're going to retire, if the entire pension and economy is going to collapse. So I think that I will make another video going into this more, to describe the creativeness and the intelligence that the United States has, and how I think they're going to govern and manage things in these times, but not right now. Okay, so but yeah, I do think that, like, look at this Nvidia all the way up here, right, relative to the NASDAQ or the S&P or NIO, for example. So this is unsustainable, right? This bubble was unsustainable. This one was too. So eventually things will get priced in more fairly. But yeah, it's a weird shame, because while a lot of the other large U.S. companies that hold up the indices and people's retirement portfolios went up, like Nvidia, NIO did not, unfortunately. And there's more to that, and the RMB could help. Do I think NIO being profitable could help? A little bit, right? Because then you have like undeniable proof that this company is more realistic in terms of stock price versus like this Nvidia, where it's like you have 30 billions in revenue, but you're priced at a 3 trillion market cap. That is ridiculous. But this just shows the weakness in the United States financial system, and how debt-driven our economy is, and how weak our economy and vulnerable it is. So to go further back into the notes I took, okay, I guess here I did talk about like exchange rates a little bit, but I don't think this is necessary, just because I'm probably going to be talking about that later. So I use CAPE, which is I use cyclically adjusted price to earnings rather than PE and price to book, and I'll explain why here. Rather than more popularly used PE or PB ratio. Now, this is in response to viewing the stock exchanges from different countries. But you could use this for NIO as well, or other Chinese companies, and compare them to United States companies. You'll probably find that their PE ratios and PB ratios are much more attractive when compared to a lot of the big United States companies, especially the ones that are correlated to the other one. But yeah, basically I use the CAPE ratio rather than the other ratios, because I think PE and PB are like 12-month records, while CAPE is more of like a long-term 10-year average. That I think it gives more of like a firm, in-depth historic outlook when looking at when comparing these metrics. So when it comes to CAPE ratios, higher CAPE ratios could suggest that the market is overvalued. This is because current prices are high relative to historical earnings. This could also mean that stock exchanges with higher CAPE ratios could yield lower future returns due to the limited justifications for future price appreciation. Lower CAPE ratios could indicate that the market is undervalued. This is because prices are low relative to the historical earnings. This could lead towards potentially higher earnings in the future due to more room and justification for price appreciations in the future. So, could we see a further appreciation of the RMB if CAPE ratios could be used as a supplemental indicator for a potential domino effect in future macroeconomic events? And that's kind of what I went over earlier. Based on the article I read from Hua, Huang, and Xiang, I think it's possible that the RMB and Chinese stocks have more to gain, while its competition, like the United States, or from other exporters, are extremely vulnerable positions with increasingly vulnerable positions due to how their economy is structured. So that's kind of what I went over just a moment ago, and I could have gone more in depth, but I won't. Not right now. I don't think this is a video for it. This is just a general overview. And so I was comparing the CAPE ratios between the Chinese and United States stock exchanges from June 2024. And so the CAPE ratios for the S&P is 32.98, the NASDAQ is 35.01, the Shanghai Stock Exchange is 16, Hang Seng is 14, Shenzhen is 21. So to go further into this, right, if the United States is losing its means of production, they are losing their colonization, they cannot extract other resources from other countries. Their high, low, and value exports are being competed with by the global developing economy. If they cannot steal resources from their victims of colonialism till this day, if they cannot extract resources from vulnerable countries because China's swooping in and saving them in a sense, then how do you justify these high earnings? Especially, and here's the thing too, it's like, to go into another tangent, there's a lot of American media saying there's war of China, right? But how can you war with a country that you're heavily dependent on, right? Like most of your companies like Walmart, Kirkland, Costco, Target, Nvidia, Amazon, they all rely on China. Okay, so like Amazon, for like 60% or more of their retailers, they rely on Chinese manufacturing, Chinese goods. Walmart's the same thing. It's like 70 or 80% of all things from Walmart are made from China. And all the things made from like your dollar stores or your Nvidia, for example, relies on Chinese supply chains, Chinese consumers, Chinese manufacturing in the province of Taiwan, which is a province of China. And look at your apples, right? Like 90% of the manufacturing comes from China. You might as well be a Chinese company at that point, but you have an American CEO, right? Or Meta, for example, too. They rely on 10 or 20% of their revenues due to China from advertisement companies. Tesla relies like 25 to 50% on China. You see where I'm getting at? You can't, or even Starbucks or McDonald's, right? They're expanding into China and they need Chinese consumers. And you can't expect other countries like India to take China's place, because China has the means of production, the skilled labor, and the infrastructure and the cultural values to accommodate capitalist and business ideas. Well, India does not. They don't have the skilled labor. And then look at your pharmaceutical companies, your tech companies. Look at your the most 5G patents is coming from China. Most of the technological innovations are coming from China. Most of the academic articles are coming from China. Basically, China is leading in everything, and even in AI, they're doing very well. They're very competitive. So, how do you maintain these high? How do you keep these high CAPE ratios justified if you have tensions with China? It's not that China and the United States are equal. They're not. They are not. China is actually in a position of power over the United States. China is actually the hand that feeds the United States. But people in the United States are under a lot of propaganda. There's a lot of nationalism. There's a lot of brainwashing. And this has been going on throughout history in the United States. And you want to do that in not Orwellian, but in Orwellian society, right? You have very similar characteristics of what you see in the United States. But yeah, so I think maybe I'll make another video to describe this even further, but the United States is in a very vulnerable position to China. And one of their means to get out of this may be a war, but China's never going to fall for that war, and there's mutually assured destruction with nuclear weapons. So you can't have a war with China either, because there's mutually assured destruction. So the United States just has to manage themselves and change in response to the ever-changing conditions. And I think the United States will do that, but you need to boost the morale of your country, right? So you can't just say, oh, China beat us in everything and we are subservient to China. So there's that. Your country's going to be demoralized and crippled. You need to use tariffs and international trade and macroeconomics the best you can, while also lying to your constituents the best you can in order to prop up morale as you make this transition. And I don't think transition is necessarily a bad thing. It's just that the United States has been, we've been so privileged for such a long time. We're just being deprivileged. So yeah, when you look at the Cape study ratios, the United States is relatively high compared to countries that own the means of production. And if I do personally believe that the United States is in a vulnerable and weak position while China is dominating the United States in almost everything, and the trend suggests that China will surpass the United States in just about everything, then, the United States always runs account deficits. China runs account surpluses, and then they use that surplus to reinvest in their domestic and other countries' economies, so they can yield a even more return, right, through their BRI. So if you look at these two countries like businesses, right, like where the United States is a debt-driven business that keeps getting into more debt, and they rely on other countries and banks to finance their debt, and they just keep getting into more debt, and it's unsustainable, and they say, well, I have $30 trillion plus on my debt, but I'm worth $30 trillion in market cap because of my debt. Like their accounting scheme practices, like, it's shady accounting. But that debt keeps increasing because you have to borrow more money due to the world decolonizing and more competition. Then your business is going to implode, right? So the best thing to do is debt restructuring, and then manage your debt the best you can. And it's going to be really hard. Things are going to get tight. There's going to be contraction. And you're going to have to the United States has to figure out how to best manage these things as other countries deleverage and their debt increases. They could become profitable over time, right? But maybe not, right? So we'll see how they do, but I think the United States will be okay. But this is the position they're coming from. That's how you should view them. While China is a profitable company that keeps succeeding, that's increasing its revenues, that's increasing its trade, that's losing its competition because competition, like the United States, is becoming weaker, and more companies want to do business with China. In a sense, more countries want to do business with China. So China is on the rise while the United States on decline. And I don't really see too many other countries that can really compete with China because, again, like people say India, but India doesn't have the skilled labor. They don't have the right demographic. They don't have the infrastructure to do it. They don't have the cultural values that support capitalist and economic and globalization as well as China. These are things that, this is the difference between how both countries handled the Opium War. So when it comes to international economics, macroeconomics, the hypothesis that the RMB appreciation is strongly correlated with the financial performance of Chinese companies and their stock prices is important. This is because China plays a major role in global exports. Changes with the RMB can significantly impact global trade balances. All players within the global economy should conduct themselves or create policies that understand and acknowledge the connection between the RMB and the Chinese companies and their stock prices, along with its implications. For me personally, I think currency appreciation and its effects could lead towards a better understanding of how to position myself personally for the future, along with being used as a supplement to predict how international macroeconomics could play out in the future. While there are no certainties and only probabilities, none of this is financial advice. Please do your own research. I think we can build a better framework and understanding of how things work when it comes to understanding our global financial markets and use comparative analysis with international macroeconomics. So these are the references I have right here. I know this was a really unstructured video, and I know I went on a lot of tangents, but how can I not when it comes to such a complex discussion that needs to try to encompass everything to determine where we think things are going to move in the future. I don't really think I have too much to talk about, but with how, I guess I can talk a little about current news and events. So with how things are going in this world, I think it's very possible that we could see, while we may not see the yuan rise in nominal value, not nominal value, but we may not see the yuan rise versus the United States dollar. That doesn't mean the benefits of a declining US dollar wouldn't be realized in the Chinese economy. Because, the United States could benefit from a lower value, a depreciation in their currency, because that's what's happening, I think, with BRICS and other countries deleveraging and decolonizing and not trading in the US dollar. But the United States is going to go through too much inflation, in my opinion, unless they keep printing more money, and I guess they're going to have to deal with that. But the United States can't really compete with exports anymore, especially with China and other developing countries. So the United States is in a really tricky position, and I'll probably make a video more specific to that and how I think things how they should handle it, and how they should respond. It seems to me like they're trying to double down on financialization. What I mean by financialization is like by the use of tariffs, trade barriers, trade blocks, things that go against free market capitalism, free markets, in order to sustain itself. But the United States is in a decline and trying to sustain itself while declining. While China is in incline, they're going up while trying to best position themselves. But I will probably talk about that in another video. But yeah, based on these things, I do think that the Chinese economy and Chinese companies could benefit from the global macroeconomic trends going on and events going on. Like another example from what I can recall off the top of my head is that China is selling more of U.S. treasuries, and then I know that China also has some of their investments in agencies, like your real estate, like your Freddie Mac, not Freddie Mac, but what's it called? What was that one that led towards the mortgage crisis? Other derivatives. Okay, so I know that China has their money in other U.S. assets and U.S. bonds, like U.S. agencies, but I know that they're also selling U.S. treasuries, which is going to lead towards more inflation because there's more money coming back to the United States. And then like you have more other countries stop using the U.S. dollar, so they're going to sell their bonds back. In aggregate, all the bonds will go back to the United States. Not all, but more. The value of the dollar will depreciate, and this will lead towards more inflation. And normally okay, but we don't really have anything to compete in terms of exports anymore, and China is just dominating all those things. So the United States is in a really vulnerable position. I think they're doubling down on their financial industry. I think that it's going to go wrong though, and I think that we could see a lot of negative impacts coming. And so you should look at it like the United States is this really skinny mountain, right? Like a skinny mountain that's a skinny mountain that's carrying the weight of the world on it. And this thing could topple at any time. While China is more of a thick mountain that has some weight on top of it, but the mountain under it is sustainable and it can carry the weight of all the things on top of this mountain. while the United States is looking to collapse. But I think that sacrifices will be made to sustain the United States and so they can navigate things properly. But I think that for me personally, there's a lot of theories on like why the Chinese stocks could be going down. Like, oh, maybe the Chinese investors are looking to move away from real estate and into Chinese equities and stocks, right? So they should be the first beneficiaries. So beat down the Chinese stocks, tell United States people that they suck, and then they'll buy it up, and then everyone else will jump in later. But when it comes to like some of like Evergrande, for example, it was mostly foreign bondholders from the United States, like Vanguard, that were punished from the collapse of Evergrande. But you gotta look at the news properly, because when you have urbanization occur in a developing country like China, you need capital to build up the infrastructure, like your homes and your living spaces, so these rural areas can move into urban areas. But so when you look at the news or you look at Evergrande, in my opinion, China had won. Plus, Xi Jinping made it clear that in 2017, homes are not for speculation, but to live in. So, to me, when you look at news, you have to take a more all-encompassing approach and to build your own understanding of things, because a lot of the news can be really misleading. It doesn't post. It's only half truths or no truths at all. And I think this world is much more planned than we think, because when you have 8 billion people in a world that's governed by international communities, and we have goals and climate change and potential for the end of all humankind through nuclear meltdown, then you're going to have all these the world countries and international communities interact and plan things out properly and do things. So a lot of the things you see or the news you hear, it can be false. And there's probably a plan for how the world is going to conduct itself and where the world's going to move. And you may want to position yourself to best benefit from that change, that maybe there's already a blueprint for how these things could play out. But with that being said, I do see all of that benefiting China a lot, actually. So I think I will probably make another video that's more specific, and I apologize for this long-winded video. I hope you found a little bit of value. If not, I'm sorry. I really am, because I just wasted your time, and I feel bad for that. I really do. But if there was some value, I hope that you can at least learn to think, at least consider how to think about things. Anyways, I hope you all have a great day, and thank you. So if you have any questions, feel free to ask. I didn't articulate myself properly. A lot of things are wrong, and it's because I'm going off the top of my head, okay? I'm sorry. And I'm not paid, so I don't have incentive to do this. Besides, I genuinely care about people, and I want them to make better decisions in life, especially when it comes to my NIO investors and my NIO bag holders. I want you guys to do well. But that doesn't mean just buy the stock whenever you want or on dips. You should buy it based on what you think's right, and based on what you think's a good deal, and what you think's a good value, and what you think is best for you, right? But it's not a beauty show, right? So just because you might find one thing beautiful, 10 other people might find someone in the beauty pageant different, right? You can look at stocks like that too, right? So none of this is financial advice. Please do your own research. I think in my next video I'll be a little bit more, I don't know, I don't think I'll go on as much tangents. I'll probably be more precise. It's been a while, yeah. So I hope you all have a great day. Thank you very much for being here. Not financial advice. Please do your own research. If you have any questions, feel free to ask. Thank you.